Hi, Jeppe. Hi, everyone. How are you? Nice to see you all today. So I can't see you, but thanks for joining here. I'm Shani Blackman, a client relationship manager at eToro. Our special guest today is Jeppe Kirk Bonde, our top popular investor here in eToro. Jeppe holds the title of being the most copied investor in eToro with over 20,000 copiers and an extremely impressive annual return per year. Today, we're celebrating his remarkable decade here in eToro. Jeppe has been featured in many newspapers around the world, and it's fantastic to have him here today with us. Jeppe, how are you?
I'm very well, thank you. How are you, Shani?
I'm great. Thank you very much. Very excited about today. I would love to start with the first question. Is that okay? Or you would like to say a couple of words?
No, you can go ahead with the first question,
Okay,
please.
I'll start. So, first, congratulations on celebrating more than 10 years on the platform. I'm saying more than 10 years because it's already over a decade here in eToro. Can you tell us a little bit about yourself, your journey as an investor during this decade?
Yes, so I started my career out as a management consultant, advising banks, aerospace and defense companies, tech companies, some of the largest companies in the world. And as I was doing that, I was making more money than I was spending. So I wanted to invest my money. And then I looked at what my bank was offering and what my pension fund were offering, and I was frankly very unimpressed. So my pension fund, for instance, they were only investing in Danish assets. So I thought, okay, that's very undiversified. I can definitely do better than that. And then I compared all the different investment platforms, made a spreadsheet, and scored each of them for how good is their app, how good is the website, what instruments are available, what are the fees, and so forth. And then I weighted all those factors and then looked at which one came out on top, and that was eToro. And then I started investing on eToro. And then my investments on eToro did very well. And then I got my first copier, and then 10 copiers, and then 100 copiers. And then it sort of continued like that. And along the way, all my friends and family members also started copying. And then in 2018, I've spent most of my career in London. I now live in Dubai. But then in 2018, I quit my consulting job to focus only on managing my investment portfolio. And then that's what I've been doing since. And then in 2019, I then became #1 most copied on eToro. And yeah, that's where I am today as well.
That's amazing. That's great. Sounds like a very fun journey. How has your financial background influenced and shaped your investment approach throughout the 10 years on eToro?
Yeah, so there are many things that have sort of come together. My dad, he was a politician, a leader of a political party and member of the European Parliament for 29 years. My mom, she was the CEO of a newspaper. So growing up, we sort of had a lot of political discussions at home. And I got very interested in politics initially and did my bachelor's degree in political science. Then in studying that, I sort of thought to myself that actually all the power is in finance. So for my master's degree, I should focus on finance only. And that, of course, then helped me get the really solid academic basis for finance, which I think is important in many regards, but especially if you want to be a good investor. And then as I was doing management consulting, I was put into many different industries, and then I could sort of apply all that I had learned about finance in those different corporate settings. And I think also I learned a lot from the partners we had in the consulting firm and from many of our smart clients and so forth. And then, being from Denmark and having lived in London, I think I've sort of a lot of little different things have come together, but definitely I think none of it would have been possible without the master's degree in finance.
Okay, sounds cool. I just want to remind everyone, all the attendees, that feel free to just, ask questions. There's a Q&A session over here, so just feel free just to ask whatever you want from Jeppe, and we would love to answer. So, considering the recent market conditions, have you made any recent adjustments to your investment strategy? And, where do you conduct your research? How is this contributed to your success over the years? I guess you, throughout the years, you went through different market, states. So I would
Yeah,
love to
so
hear.
there's been some industries where I invested in heavily, and then suddenly those prices came up a lot, and I sold everything and thought to myself, oh, now I wasted all that knowledge effectively because now I don't want to invest in that industry anymore. But then sometimes years later it comes back, and something that like an example that is renewable energy. I had a lot back in the past. I sold most of it. Now the price has come quite far down, and I've bought back quite a bit. I think over the past few years, the real big categories of change for the portfolio have been towards artificial intelligence and towards sort of a more dangerous geopolitical situation. So those have really influenced a lot of the, sometimes there's one or two assets that I have for very specific reasons, but sometimes there can be some big factors that really impact most companies. And so they can really sort of, make or break that I'll have these companies instead of these ones in the portfolio. And definitely since I got really heavily focused on artificial intelligence back in 2017, that's taken up an increasing part of the portfolio.
Okay. So I would love to hear a little bit on your thoughts, on the current market conditions.
Yeah, so I think it's currently a very exciting time to be an investor because we get to live through one of these big foundational technological revolutions that I think AI will become. So it's really, really exciting to be there evaluating all these companies that are, doing amazing things in this space and seeing, potentially the ones that are ahead, they can get overtaken. This might impact some other companies that can save some money. So that's very exciting. From a macroeconomic perspective, we are sort of at this, balancing on this knife's edge. Inflation remains sticky and potentially difficult to get away from, and it's not guaranteed that the economy can perform well if interest rates aren't lowered, or worst case if they even have to be raised to curtail this inflation. So that sort of provides a little bit of a dangerous back environment. And then finally with the geopolitical situation, from everywhere from Taiwan to Ukraine, there's some heavy things going on that are terrible and that you have to analyze, and then that sort of I guess there's all the bad things, but at least it makes for exciting analysis work.
Okay, so has something specific caught your attention recently? So with your experience, which industries caught your attention recently? There's anything specific that you said, "Ooh, that's interesting. Maybe I should invest in it," or a little
So
bit more?
the biggest position in my portfolio now is TSMC, so a Taiwan semiconductor manufacturing company, and that's they got a really amazing. There's basically no one else like them for producing the most advanced semiconductors. They are, however, based primarily out of Taiwan, which puts them in a geopolitically very dangerous spot. So sort of if AI develops right, if they can maintain this extreme competitive position and nothing bad happens with China, then they can provide an extraordinary growth case and a profitability case. Then in terms of industries, I'm slightly more exposed than average to technology, but also to financial services, to mining, to electrification. So a balanced approach of renewable energy and a little bit of Tesla and like Airbnb that has some of the products that are sort of bridging the gap from producing the electricity to actually using it out for the end consumer.
Okay. So I love this question because I think it kind of gives us an overall look over the past decade. So looking back at your investment journey of more than 10 years, which specific investments are you most proud of and why? How did it contribute to your overall success?
So the best one has been Nvidia. I bought Nvidia all the way back in 2013. Unfortunately, I sold off along the way. It's still a large position for me, but I've effectively always had a very solid approach to risk management. So I never allow one position to become very big. And now TSMC, my biggest position is just 5%, but Nvidia has been the best performing position. But I would say the one I'm the most proud of is actually Tesla, because that's the one I've been criticized the most for. I bought Tesla back in 2016, and it didn't take long for one of my good friends who works in mergers and acquisition who told me, yeah, but only people who don't understand finance invest in Tesla. And he was shorting Tesla at the time. And every time Elon Musk went out and did something really, really stupid, I typically bought more Tesla. And But sort of, in facing so much criticism for that one stock, I really had to think like, can I carry on with this? And then I just decided it becomes too complex if I have to start thinking about what other people are thinking. I'm just going to invest in the assets that they think are the best ones to have for me. And then that's going to also be good for my friends and family and other people that copy me. And then I will, if I've done my analysis right and things work out right, then I'll be proven right over the long term. And then I, can sort of ignore that some people don't believe in this stock right now.
That's amazing. It's an amazing story. So what is your long-term investing goal and how has it evolved over the years?
So I guess sort of my long-term goals don't play too much into my day-to-day. Every day I, look at my portfolio and what I want to own. And then if there's any difference, then I, sell something and buy something to make sure that what I should be owning is what I'm owning. And so if every day I focus on making sure that I'm invested in the assets that are the most valuable compared to the price, then sort of all the other goals, they sort of fulfill themselves somehow. But, back in when I was not number one on eToro, I was very excited that, I could become number one on eToro. Then I was comparing myself with other of the most successful long-term fundamental equity investors. And I wanted to have the highest return on average amongst those. And I also got to that point. And then now effectively, the final sort of challenge would be to say, okay, who has had the highest lifetime return of any investor? And that's Warren Buffett, but that's pretty hard to catch up to. Effectively, if I continue at the current rate for 40 years, then I should overtake. And yeah, I mean, he's still going strong at 90 something. So yeah, he's definitely not making it easy for anyone to ever catch up to him.
That's true. That's definitely correct, but it's an amazing goal to look up to. And I think it's really important for everyone to have someone to look up to. So lastly, before we're going to go to the Q&A session, do you have any messages or advice for copiers or potential copiers or considering copying you on eToro right now?
Yeah, I think there's sort of an approach that's good for many people, which is you start out with just making a demo account. So to just try the app, then you can, maybe you're using your iPhone to try the app and you go in and you see, oh, I can actually invest in Apple and this is what the buy button looks like. Then you can invest a small amount so that if you do make a mistake, at least you didn't do it with a giant amount. Then for investing any sort of larger amount than that, it's really important to consider, that you're not investing more than you can feel comfortable losing, that you invest money that you're, don't have a clear requirement that you need within the next few years, because mostly when you're investing in stocks, it's really supposed to be a long-term endeavor. You can compare it more to investing in a property. Like if you're buying a home, you're not buying it that probably to sell it tomorrow. And that should a little bit be the same with stocks. And then finally, if stocks are right for you and you do have excess cash that you do want to invest, many people, they make it a regular habit to, maybe every month when they receive the salary to invest a part of that, or maybe once per year when you sort of calculated how much cash you need and how much cash you don't need, then that can be a time to increase one's investments. For many people, stocks are good, property is good, and yeah, then there are some things that are not so good.
Okay, so let's dive into the Q&A session. Thank you, Jeppe, so much for your insights. Let's just go now to the first question from Mark. What are the top, I think you kind of answered that, but maybe you would like to answer it a little bit more specifically to what he asks. So what are the top 3 factors you consider before investing and when prompts you to sell?
So I value automatically more than 2,000 stocks, and then I cover about 200 that I then follow more closely every day. And so I can always see, how they are performing in terms of numbers and see how that adds up. And then I'm always, spending my time doing analysis of different niches. It could be, maybe I'm updating how much taxes I think companies are going to be paying in a certain country. Maybe I'm updating how much, a certain industry is going to grow based of these factors. Maybe I'm updating, I can be looking at one industry on one specific number for all companies like that. And with that, I'm just always updating my total valuation framework. And then I can always see how the companies stack up against each other. And, sometimes, the price of one has gone up by a lot, but I don't think that, it's warranted. And in that case, I will probably sell that one. And other times there's a company that I think, maybe they made an announcement, a new product, then I have to spend a long time understanding this new product. And if I then find like, wow, this is actually a complete game changer. This is like a different company now than it was, the day before they announced that, yet the price hasn't caught up to that. Then that might be one that I want. So then for different kinds of companies, what are the three factors? It can be really, really different, because different companies, if you really, it's three very different numbers that determine whether Apple is a good investment or whether like a copper mining company is a good investment. Like for Apple, I don't care about how much copper reserves they have. If they have any, maybe they have a tiny amount of copper reserves. That just does not matter at all. Where that number can be very important for the copper mining company. And somehow like I don't have to check the latest product from the copper company. Like they're making the same products that they've been doing for a long, long time. So it's sort of for every company there'll be different ones that are the really important ones, and then for every company you can still look at all the other stuff. But you really, if you get sort of the for any particular company that you're valuing, if you get I would say like 5 most important numbers estimated somewhat well, then you're off to then probably you're gonna make a good decision on that one. And if you fail on those ones, then probably all the less important numbers, they will be much less important. But I always look at stuff like growth and profitability, and then tie that back to the real world. It's not enough for me that I just see like a company's making a lot of profits. Like I really need to dive in and understand why that's happening. Like what do the customers like about this company? What's great about their product? Why can't the competitors do the same? Like why all of that kind of stuff.
Okay, thank you, Jeppe. Mark, I hope we answered your question. Let's go to Tani. So Tani asks, can you tell us about the key moments when you increase the number of copiers, and do you have any suggestion to PIs based on the lesson learned?
Well, it's been a very sort of steady progression, and it doesn't sort of like collapse or jump enormously from day to day. Whenever I've been featured in a major newspaper or something like that, that's attracted more copiers. Then there was a big boom for my number of copiers and for eToro users in general, and I think for investors in general during COVID, because everybody was at home from work, and so many people had for a long time been in this situation where they thought, I want to start investing. I know I should start investing. I'll do it this weekend. And then the weekend comes and they're tired from work, and then they don't get around to it. But then during COVID, when people were at home, then there just was this explosion in the amount of people that started investing. And also there was a sort of because companies like eToro suddenly made investment actually accessible for people with less money. Other large brokers, even today, and definitely a lot more back then, would sometimes charge like $20 to make one trade. So if you're only investing something like $1,000 and you want to invest in 10 different stocks with $100 each, it's just prohibitive if you have to pay $20 for each trade. But when it's instead like a very, very small percentage that you're paying when you're buying and selling, then it's just a whole different game, and that sort of really made it accessible at that time. And so sort of people being at home, people having checks from COVID, and this having been so accessible, that just really made a lot of people come into the investment world. And I definitely saw more copiers from that as well.
Okay, that's amazing. So this is for Patrick. Hello. How often do you consider updating your portfolio with new assets or remove poor assets? Thank you.
Every single day. There's never a day. There's never a day where I don't look at my portfolio. Like that's Saturday, that's Sunday, that's just I don't do like I wouldn't do a holiday of going out to some zone with no internet access. Like that's just the kind of holiday that I wouldn't do, because I want to be able to go on the internet and see how my portfolio is doing. And it does. I don't make changes every day. On average, I think my trade frequency now is like 3 trades per week. So I don't have to make changes every day, but I have to check every day to ensure that that if there's some major announcement, if there's some major change in something, do I still want to own this asset? Is another one I want to own instead? That's just and even I can't stop myself either, because everywhere I look around me, I'm insanely curious to understand everything. And so if I am out and I see some new product that I don't know about or something, like I just want to get out my phone and see, how much profits are these guys making? Is this like is this the future? And so then you can basically not turn it off.
It's a never stopping job, basically.
Yep.
Okay. So now from John. Hi, Jeppe. how do you diversify your portfolio according to industry, etc.? How do you see next year in the matter of stock value growth?
So in terms of diversification, I use my own risk framework, and then I use eToro's risk framework. So eToro scores all portfolios on a scale from 1 to 10. 1, you are taking very little risk, and 10, you're taking so much risk that you will not be allowed to be copied by anyone. And there I'm usually on around a 4, sometimes down to 3, sometimes up to 5, but around that level. In terms of my own framework, I can slice and dice my portfolio in many different ways, and I do that because I like to look at it in different angles. So that can be taking a sector view or a geographic view or an industry view or a thematic view, and then sometimes I will notice something where it's like they have collectively grown a lot. I'm kind of overexposed to this particular general category of risks, or in this particular scenario it's looking bad now. I can see that if this thing was to occur, then probably so many of these stocks would lose so much, and that's putting me in a too dangerous situation. And then there should be some change that's the like just doing that less, and then if that's not doing poorly on a lot of other things, then that's a change worthwhile. And if then there is some change to the portfolio from that I want to make, then I just ensure that that's something that would be good from my own risk framework and from eToro's. And sometimes where I can find extra value to add into the portfolio is that I think there's something that I can do that will increase my average expected return of the portfolio without increasing the risk. Other times there's something where it's like, what, this will make me the same, but it's slightly less risky. And then sometimes there's something where it's like, okay, this is going to increase the risk of my portfolio, but it's worth doing because I think this is such an attractive skew for the portfolio that I find it worthwhile to increase my risk a little bit to capture that extra weighted average return across scenarios.
Okay. So this question is actually from a fellow PI, popular investor. Hi, Shani and Jeppe. Quick question for Jeppe. What do you think was the key to growing your presence both on and outside of eToro? Thanks for answering.
So I think it's I sort of took the philosophy that if I just do everything as well as I can, then I don't have to specify which exact thing was did it right. It just overall work out. So I think certainly communicating nicely and doing things in a professional manner, that is something that can help, provided you already have high returns. I don't think anybody's going to copy anyone that has bad returns. So you really like that really comes first. So doing all the hard work it takes to be on top of markets, to invest in the assets that are good deals. That's really the big part of it. But then there's no reason why you shouldn't also communicate nicely and act professionally. And yeah, if there are some, I also in the beginning reached out to newspapers myself before they started reaching out to me and so forth, and then potentially all of these things sort of create a little a positive circle where one thing reinforced the other, and then it helped me along.
Amazing. That's an amazing answer. Thank you, Jeppe. Okay, so that's actually a funny question. That's a very nice hairstyle, Jeppe. How is it called? Yeah, I don't know if you want to answer that, but I guess you want to thank them for the compliment.
Sorry, I didn't understand that question. Can you repeat it?
He said, that's a very nice hairstyle, Jeppe. How is it called?
I don't know. I had a long debate with my hairdresser over it, and I'm happy it worked out.
Eva, it's a great question. Thank you. So we just answered it. Let's mark is done. So from Jordy, hi, Jeppe and Shani. Since I copy you, I have 6% increase. That's great. Is it a good moment to add funds, or it would be better to wait to your advice? Regards from Barcelona.
So in general, right now, I've invested in the assets that I think are the best ones to hold. So I generally don't like having a lot of cash, and it would be a very extreme situation where I would be holding a lot of cash for a longer period of time. So at any given time, like if you have a lot of cash or stocks or whatever, you gotta deploy that in the best way possible. And cash, because of the constantly increasing money supply, constantly loses out to inflation. So sort of in any given year, cash might be the best assets because stocks did poorly, but sort of on average over many years, maybe stocks, they doubled, stocks went down by half, stocks went up by 20%, stocks went down by 30%. But when you average that out over a long time, historically, that's yielded a real return per year of 7%, whereas cash has historically on average yielded a negative 3% per year. So just holding cash, even if you're really, really good at being in cash at the right time or something, it's just extremely unlikely that will outperform over the long term. So that's why I'm generally, if I have a lot of cash, I generally want to get it invested into some stocks as fast as possible. But that said, if everybody, most people in most situations want to, have at least some cash or credit available for likely upcoming expenses. It shouldn't be it shouldn't be that if you get a dental bill, then you suddenly have to sell your stocks because now you have to pay for the dentist or something. Likely expenses that tend to come, there should be enough cash to pay for those. But if people have a lot extra cash that is just sitting there earning a very low interest or something, then it can definitely be worthwhile to think about getting that invested into some higher yielding assets instead.
Mm-hmm. That's an amazing answer. Thank you, Jeppe. So let's go to Alex. Hi, and thanks for taking the time to talk to us. Are there any specific events in the past decade that significantly, shaped your investing approach? If yes, can you tell us about it?
Yeah, I definitely. It was actually. I would say I've been to San Francisco a few times, but I think the trip I took there at the end of my master's degree, where I visited companies like Google and Facebook and whatnot, I think that really gave me my investment strategy when I started out had the title Californication as a taken from the Red Hot Chili Peppers album. But because I just had the vision of the future, that in the future we're all going to be living in Californian culture using Californian technology, and I want a large part of my portfolio to reflect that. And that future that I envisioned back then is very much the future we are living in now. And I think sort of that I also say my university exchange to Boston College in the US also sort of, I was using some different things there that I think were, there were some startups in America back then that I could just see like this is the future, and that we didn't have those things in Europe yet. So I think if I had been in Europe at that time, I would maybe not have noticed those things. But because I was in America at that time, I saw some of those things, and then I was able to sort of not just invest in the right companies based off of that, but also understand how they would influence other companies. And yeah, that's not the entire sort of story, but that was definitely that helped me to some degree, certainly.
Okay, that's great. Let's go to Theodore. So it's great to hear your thinking, provide your perspective over the current situations, etc. If I copy you, how would I stay updated with this info?
Well, so you can always go into the eToro app and see exactly what I have in the portfolio. So that's visible every day. And then I do a quarterly investor update where I answer questions like I'm doing now and provide my sort of take on the state of the economy. And I showcase some numbers from different companies and what I have in the portfolio and so forth. And then I do a post regularly on eToro where, if there's some major event that's happened in the market, I might do like some commentary on that because I know that might be something that's very important to a lot of investors at that very time. So that's sort of the way. I don't do like a daily market commentary. I don't do sort of a weekly newsletter, anything like that. But I'm very active on eToro.
Okay. That's correct, actually, and you can look at Jeppes' profile, and there are always questions from his copiers and followers, and he always loves to answer and respond, either in his quarterly, calls or just in a message. So make sure to pop in. Okay, Elio Ministeri. So he asked how your investment approach has evolved given the significant shifts in interest rates since you started investing on eToro. Now that the scenario is different, what do you think could alter the market dynamics that have been prevalent over the last decade?
Well, firstly, I don't base my valuation of companies purely based off of what the interest rate is right now. The interest rate will be at one level now, then it'll change, then it'll be at another level. So it's important what the interest rate is going to be through the entire lifetime of a company. And if you have an environment with persistently higher interest rates for a long time, that means that companies that have a skew of their profits towards the far future, they become worth a lot less. And so as interest rates started rising, and I, changed my outlook to a perspective that they're gonna be slightly higher for a long time. Then there were some companies that were quite far from profitability that, with high growth and whatnot, that I chose not to have in the portfolio because effectively they were just overtaken by other better investment opportunities in that kind of interest rate environment. And hypothetically, if the interest rates had stayed, down at negative real rates, but nominally very low as well, then hypothetically those companies would have been worthwhile having. So that's sort of a cause that skew. Also, a lot of companies that were severely indebted, where there's like that debt is not such a big problem if you're not paying any interest rate on it. But as interest rates were coming up, I also reduced the amount of companies that I have that have a very high debt, basically because of the punishment that they would face once they have to, change their debt structure and pay a lot higher interest rates.
Okay. We have another question from the hairstyle guy. On a more serious note, which books would you say have influenced your investment style the most? Would you recommend them for a beginner like me?
So I think the one that has probably influenced me the most is the one called Valuation, measuring and managing the value of companies by Kohler, Goodhart, and Wessels. It's basically a McKinsey book, and it's just a big fat textbook that we used in university for how to value companies. And sort of that's really valuing companies. That is the heart of investment, because you're going to be buying something, you're investing in something, like what is that worth? And that book is really the Bible for that. And so yeah, I think there are then sort of there are many areas that you can then, based off your style of investment, dive more into. I read some great books about financial accounting that go more into the numbers behind the numbers and the stories behind the numbers, how I've read what are some other ones, the Nicholas Nassim Taleb. I read all his book, Black Swan, several times. I think that had a very big influence on my view on investing as well. I don't agree with everything he says, especially not on Twitter, but I think there are some guys like him that are sort of very outspoken, and they know some stuff that's really good, and if you can just sort of like overlook all the other stuff, then there can be some good insights to be gained there.
Okay. So given your detailed analysis, what's your view of Bitcoin or new investments?
So if we look at crypto in general, I'm not a fan. I don't really like the blockchain technology. I don't think that's a very good technology. I like the idea of having a private currency without a constantly growing money supply, which is what Bitcoin represents. So I think that is can be really, really good, especially if others cannot get inflation under control. Then there's a really strong appeal for having a global private currency with a fixed total supply. And in that's sort of the digital version of what the role that gold fulfilled back in the day. And then in terms of now using Bitcoin raw on the blockchain is very, very expensive, very cumbersome, and thus not that great. But in the same way that gold was a great gold coins was a great currency, but it wasn't the greatest it wasn't the best system of transactions. So we built layers on top of gold that made it much easier to sort of say that I transfer ownership of this gold to you via this piece of paper, but we don't actually have to move the gold. And we can do the same on top of Bitcoin by doing second layer technologies, where we're saying, we are trading on a different system, but once every day we update it on the blockchain. And then if you do it that way, you can make Bitcoin payments really, fast, simple, cheap, safe. And if we do that, and then people start actually paying with it out in the stores, and people are receiving their salary in Bitcoin, people are buying their house in Bitcoin and whatnot, then I think it then you sort of then it's actually hard for normal currencies to compete, because you're just saying, why should I receive my salary in a currency that's just losing value constantly because others can just grow the money supply? Like when I can receive my salary in a currency where the money supply is fixed, why should I be, buy a lot of stuff from Amazon, and then I have my investments in Amazon, then Amazon, then they do buybacks and I receive my money from Amazon. So as we are spending money around, that money is always kept between me and Amazon. And, why should we constantly be taxed at this rate? There's really no good reason for us to pay this high price. So I think that's really the golden underlying key for Bitcoin, and I think it's that gives a really, really great opportunity for Bitcoin. And I think the thing to look out for is just really the sort of changes that are coming for this second layer technologies. If we can actually make transactions easy for people, and if we can do that, then I think it's then it can get a really, really good valuation.
Amazing. So you mentioned Tesla before. This is from Richard. Hi, you mentioned Tesla before. What are your thoughts today? Thanks.
Yeah, now I just cast my vote. I would encourage everybody else to go in and vote for if it's there's still time. Maybe there's still a bit of time.
There it is.
And yeah, follow the board's recommendations. You can see the board is suggesting to vote yes to some things and vote no to some things, and I think those recommendations are good. So I encourage everybody to go in and vote your Tesla shares, and yeah, give Elon his money that he so rightfully deserves. And in terms of the company, I think there are some for the electrical vehicles market. I think it's very tough now with the massive push from China. That's you're effectively competing in a market against a country that's willing to do this at next to no profit margins. So that's very, very tough. But the sort of the long-term outlook for having some of the smartest engineers working on developing full self-drive and yeah, building potentially robo-taxis in the rest of the world, especially if you get into a conflict with China, and then transitioning over to making, a whole new generation of devices, whether that's, two-legged robots or something else. I think that's certainly worth a lot of money. And I don't think compared to sort of the probability of that working out and the profits, if it does work out, compared to that, the current valuation is quite low. I think if you're just valuing them, like saying like how many electrical vehicles they're going to sell this next year at what margin when China's doing like this, then that's not the reason why anyone should be investing in Tesla. It's really for sort of if you believe in this engineering team and what they can achieve a few more years down the line. Everything's always a few more years down the line with them, but it's at some point it won't be.
Amazing. Okay, so another one about Bitcoin. Will this Bitcoin cycle have a post-halving bull run, and when, in your opinion?
So I think the halvings they get way too much attention. I don't think that's. I think people should completely ignore that in terms of deciding on Bitcoin effectively. It's effectively there is a category of investing called event-based investing. It's a terrible category to be in. If you're always investing based off of the next events that are going to happen, then you're going to be changing your positions, paying fees each time, and on average, you will not be sufficiently better at predicting those events than the weighted market average. So your overall returns, even if you're amongst the best at doing that, will be quite average. So it's much, much better to analyze, make big important analysis that others are not doing, and then you get the market average plus your alpha plus the extra returns from having done those other analysis. If you're looking at the same event that everybody else is looking at and with no like extra insight for it, then you're not gaining anything extra. Then you might as well just accept the weighted market average opinion on what should be the impact from that particular event. So I think that's not the like you can more or less predict when the harvests are going to happen, and then that'll adjust your valuation of Bitcoin a tiny bit, but that's completely unimportant like in the grand scheme of things. What's important is really whether or not this can become really, really easy to use. And if it can become really, really easy to use, then it becomes very, very hard to compete with.
Okay. Another question from Ewan. We'll have to finish soon, so let's just answer the questions as fast as we can, but we'll try to answer everything today. So, hi, thank you for your time today. What indicators do you have, do you use mainly? Thanks again, Ewan.
So they are all my own uniquely crafted indicators with their own funny names. So I don't use EBITDA, I use Jeppes, and yeah, lots of funny names like that. And effectively, all of the ones that I look at every day, they are all variables that are made up of a lot of other variables that under them have a lot of variables, and then it sort of towers up like that with a lot of weights. And so I don't look at any sort of like I would never look at something as basic as price earnings or something like that. I have my own sort of framework that tells me what I need to drill down in, and that I've spent my the last many years of perfecting and improving. It's a never-ending work because you can always, hypothetically, if you wanted to be the perfect investor, you needed to know what every single photon in the universe is going to do, and obviously you can't know that, but you can try to find a way to ensure that the most important data is running smoothly in the models, and that the some data is just coming in automatically all the time, so that's really easy. Then there's other stuff that I gotta sort of manually decide on. Do I really think it's like that, and where you can't just like you can automate it, but then you gotta automate it in a different way next week. So it's sort of other stuff like a company released their earnings, so now that's a new earnings number that just goes in automatically.
Okay. Hi, Jeppe and Shani. This is from Denise. Does this Californication strategy include investing in cannabis stocks, and how do you predict the future of these?
It did. And back when the first cannabis companies came out on the stock exchange, back then there was no like a big report you could read on the cannabis industry, so it was very sort of wild west. But it also made it very exciting. So I was calling friends in Canada, trying to figure out like what's it like working in this new industry. What's the sentiment in Canada? How is this like just a short-term thing happening there? And then I spoke with the different people in European policy and stuff to figure out what was the mood for regulators and so forth. And then I built some big position in cannabis, and they went up a lot. And then I sold near the peak, and then I bought back near the bottom, and overall that was very well. Unfortunately, I held on to Tilray after the merger a bit too long, and sort of then I don't have any cannabis in the portfolio now. And at some point, I sort of changed my outlook for the long-term profitability of this industry. I think, unfortunately, there would be a lot of competition in the long term, and not the sort of super high profit margins that you could have hoped for. So even with full legalization, it's the total amount of profits that are going to accrue to the leaders that have already racked up a lot of debt and are losing a lot of money will not really be, they'll become decent companies and so forth, but it just doesn't make them as good investment opportunities as some other ones. So yeah, if legislation changes, profitability changes, and prices changes, all of those things, then yeah, probably. But otherwise, I'm not sure I'll be getting back in that just yet.
Okay. A question from Mona. This I think we can answer just like that. Fundamental analysis or technical analysis, which one do you follow the most?
100% fundamental analysis. It is to me that is
the easiest
astronomy
question.
and astrology. There's technical analysis is complete mumbo jumbo. It has no place. No good university or investment bank will tell anybody to use technical analysis. That's something for silly YouTubers with it's useless.
Okay. Let's go to Tani. Do you regularly use take profit and stop loss? And how do you set them? How do you rank 1 to 10 your discipline in following your investment principle, and in particular TP and SL?
So I never use a TP and SL. If anybody knows already that they want to invest their money differently if they hit a certain level. Maybe I say like, oh, if my portfolio increases to this amount, I'm gonna sell it and buy a car or something. Then you can sort of take profit at that level. If you know that if my money goes down below this level, then I just want out. Then I cannot be comfortable with that level of loss. Then you consider a stop loss at that level. But when you're setting a stop loss or take profit, you're basically pre-programming what I would call an untimely panic action. So, if the price of something goes down significantly, that doesn't tell me whether to buy or sell. If I have a company, a simple company, it owns 2 hotels, and then I find out tomorrow that one of the hotels has burned down, and the price has fallen by half. I'm like, oh well, there was 2 hotels equally valued. The price has gone down by half, so actually now it's fairly valued. Nothing has really changed. You're paying the same per hotel as you were before. If, however, I saw that the price has gone down by 75%, I'll be like, wait a minute, this is only worth half, of what it was before, but the price is 4 times lower. So now I'm getting like, a twice as good deal. I should buy more in this. So if I was going to be then looking to buy more, like, why would I then want to pre-program it to automatically sell just because the price fell a lot? That makes no sense to me. So I think it's important to really be mindful of risks, to ensure that you are well diversified, and set the take profit and stop loss if that's feels really suitable and suitable. But that's just not how I deal with risk management. I deal with risk management by being diversified across many different assets, so that and with those specifically understanding how they could perform in different scenarios, so that in the case where this one goes very well, yeah, that might make this one do very poorly. So those average out, so I can be I don't have to worry too much about that risk in if that works out, and rather than being like, oh, if things fall a lot in price, I'm just going to sell everything, right? Just because everything's fallen in price doesn't mean that now's a great time to just own cash. So yeah.
Okay. Hi, Jeppe. Just another question about Tesla. Do you think Tesla's AI most valuable than its car business?
I think it's a balancing act of having the manufacturing technologies, the AI, the data that's necessary to run that AI. It's sort of those things combined that puts them in a really unique, good position. And there are other companies that are sort of approaching the same level of capability in some of those areas, but there's really none that have that full combination. And then it's ultimately probably the most difficult exercise is in the AI front, and so that's where the most of the value will really be created. But I mean, they're not there yet, so you cannot say that sort of the real value is in the team brought together that will likely develop that, and they have the necessary hardware, data, and existing AI technologies to build that.
Let's go. We have another 3 questions. Let's just go fast over them. So what is your opinion on investing on NASDAQ 100?
So in general, it's fine to hold NASDAQ or the SP 500 or something like that. People just have to be mindful that when you are investing in an index like that, you're only getting American companies. It's heavily skewed to the biggest ones, and especially the technology stocks. So it's not really a well-diversified portfolio. So you're buying an index like that, you are you're paying recurring fees to not have the best diversified portfolio. But it's like that's a better way of investing still than many other ways. There are lots of much worse ways to invest, and I think NASDAQ has some, it is skewed towards a lot of companies that are really, really good, and I think are great investments right now. So that puts it in a good position.
Okay. Let's go. What do you think about the companies in the entertainment industry going through the transition to subscription models like Disney, Warner Brothers, etc.? Do you think they present a good investment opportunity?
So I bought Netflix early on, and I've had Disney in the past as well, and then now I'm not the biggest fan. I think there's a severe amount of competition and long-term problems for that particular industry, and I think the prices are quite high, so it's not the best deals there. And I also think it's something that if you want to enter that market later, you can. So it's not it's not my favorite.
Not your cup of tea. Okay. So another two questions. I have been buying all I like, and my portfolio has grown to 260 assets. What's your thoughts on this amount of assets?
Yeah, that's fine. I mean, it's fine to have lots of assets. There's you can of course, you can have 250 tiny positions and then one very large one. Then that puts you in a different risk position. Of course, it's more difficult to keep a daily eye on all the most important things that have happened with 250 something companies in so it's the more companies you spread out your knowledge across, the less time you can dedicate to each one. But then on the flip side, there's so much stuff that if you're good at maths, you can use that for all of these things. If you learn a lot about like how this technology works, then you can use that across all of them. So I think it's fine to have a very well diversified portfolio with lots and lots of different assets, and then just be mindful of how you can sort of analyze them in an efficient way with some things where like, well, if I analyze this for all of these ones like that and all of these ones like that, then I can keep on top of them. Because if you're gonna do sort of like now let me start with this one, then let me go to that one, then let me go there, then you'll sort of you'll never manage to stay on top of them.
Okay. Just saying, we're gonna have to answer only the question that we have here right now because it keeps coming. So we're just gonna answer right now. And then if we have any more questions, feel free to go to Jeppes' profile, continue to ask over there. So we're just gonna ask another two questions and that's it. Sorry, Jeppe, we have another one popped out. So don't you like Novo? It's not in your portfolio.
Yeah, that's my biggest failure as an investor. It's even from I'm from Denmark, and Novo Nordisk is the basically only company from my hometown, and I didn't invest in that one. So yeah, that's just terrible, and yeah, I'll be feel bad about that forever, I think.
Oh no. Okay, so last one, Amazon, Google, Microsoft, Meta, and some of the biggest parts of the QQQ and S&P 500. Can't we consider that we have some international exposure when we invest in those indices, because those companies operate all over the world?
Yeah, so when you think about geography, that can mean a lot of different things. You have companies that have revenues all over the world, but maybe they're manufacturing only in one or two countries. So then their cost basis could be completely different from their revenue basis in terms of their geography. Where a company has their headquarter can also be very different from where they have their registration. You can have a company that's listed on a stock exchange in a different country from where its headquarters and so forth. So you got to look at all of these different dimensions when you're thinking about geography. Then you can weigh them up and say, where they are selling is more important than where they have the cost base, and for certain aspects. But when you have a company that's selling products all across the world, then of course their revenue isn't just dependent on where they are headquartered like that. That's so definitely if you have companies that are that have sales all across the world, then that does provide a level of geographical diversification.
Okay, so this was our last question. As I said before, everyone feel free to go to Jeppes' profile, ask all you want. Jeppe loves answering questions and he's doing it very great, as you noticed today. It was great having you all. Thank you, Jeppe, so much for joining us in this webinar. It was amazing. It was lovely. It was great to hear your insights, and bye-bye.
Bye-bye. Thank you, Shani.
You're welcome. Bye-bye. Bye, everyone.